Welcome back to another group valuation. Thank you to everybody who requested companies. I really appreciate it. If you don't see your company on here, that doesn't mean I'm not going to do it. This is just the 6 I decided to go with for this video. I don't think I'm going to be able to do another group video this weekend. I just don't have enough time. And maybe I'll try to do one next weekend. During the week, it's tough because these videos, all my videos take a long time, but sometimes I have to split them up between multiple days. And it's just way easier on a weekend where I don't have to worry about the market being open and the stock price changing drastically while I'm, in the process of posting or something like that. All right, so let's see. Let me just run through the list of these companies and give you kind of a brief description, and then we'll go through our quick screening process. So first one's going to be Credit Acceptance Corporation. So they are a financial company. They provide financing programs and services to franchised automobile dealers in the United States. The company advances money to dealers in exchange for the right to service the underlying consumer loans. All right. Next will be Callaway Golf Company. Okay. This one really intrigued me. So they're a golf company, right? They sell golf equipment, golf apparel, other accessories. But here's the neat thing. They also bought Topgolf, which I don't know if any of y'all have ever played Topgolf, but I've only done it one time. It was like a year and a half ago, and it was super expensive and it was super packed. And the first thing I did while I was there was look up, is this a public company? And I think I remember seeing that it wasn't. But now it looks like Callaway bought them, so that's interesting. Anyway, I'm excited to do that one. VF Corporation is next. That's a what do you call it? Apparel store. So they're pretty much known for, what is it? I guess I have it written down here. North Face, Timberland, Smart Wool. Those are the first three that they list, okay? So we'll do VF. Then PayPal. This one is really interesting. PayPal has crashed recently. I mean, like down 70, 80% in 1 year. So I'm really interested to see if this one comes in anywhere close to fair value, and it could be a cool time to jump in and buy this one. I think everybody knows what they are. They're a digital payment broker, or whatever you call it. What do they exactly describe themselves as? Enables digital payments. Okay. All right. Then Sprouts Farmers Market. We actually have one of these relatively close to my house, so I thought this was neat. I didn't know this was a public company either, So they are like a Whole Foods type place, organic, natural, expensive grocery store that I don't go to. All right, and then lastly, we have the Scott's Miracle-Gro company. And this is another one that I know and one that I use a lot, especially for my yard. And we put freaking Scott Weed and Feed, Bonus S, Turf Builder, all that. All right, so that's what they are. In my head, let's see what they describe themselves as. Manufacture, marketing, sale of products for lawn, garden care, and indoor and outdoor hydroponic gardening. Okay, awesome. Let's get started. First up is Credit Acceptance Corporation. Okay, so once again, let me orient you a little bit. I have every quarterly report. That's what this is, this graph, and we're going to go through all the different fundamentals quarter by quarter and see what the trend is, try to judge it from that way. And then I'm going to, up top, mark them with a green light, red light, yellow light for the balance sheet and income statement. And then I'm going to do just a quick back of the hand calculation for the fair value and see if we can get something there. Okay, so first off is total equity. Yahoo Finance describes it as total equity, gross minority interest, but it's, total equity. What's interesting here is, not interesting. What's not good here is that, we're dropping recently. I say you always want to see this going up because this is like the net worth of the company. So if the net worth is going up, that's a good sign. If it's going down, it's not such a good sign. So that worries me a little bit, the shrinking equity. I'm going to see if it's on a per share basis. So to do that, I have, real quick, this is tangible book value. It's about the same as equity. The difference between tangible book value and just plain equity is that tangible book value doesn't give you credit for intangible assets like goodwill. So it's kind of a better measure in my opinion, but for simplicity's sake, I usually just look at equity for these screening videos. Okay, but here's tangible book value per share, and you can see that these two patterns look pretty different. Like, let me show you again. So here is your tangible book value, and it's really decreasing. I mean, you're almost as low as you were, in 2017. But if you look at it on a per share basis, your tangible book per share, you're actually, way higher than you were in 2017. You were $80 tangible book value per share, and now you're $120. So that's a little misleading. Not misleading. That's a good sign because while equity growth is good, what you really want is equity growth per share because that's what you're buying, right? You're buying shares of equity. So why wouldn't you want the equity per share to be going up? So the only thing that will explain that though is if they're buying back shares, which they have to be mathematically, yeah. So this is a good sign because if a company's buying back shares, it means that management thinks the stock's undervalued, or it should be. That's the only reason management should buy back shares, right? If they have nothing else to do with the money and the stock's undervalued, it's a great time to buy back shares. So this is good. This is just number of shares. These dollar signs shouldn't be here. But anyway, you went from, what is this, like 18 million shares outstanding to now, 13 million. So awesome. One thing I want to look at too, because I'm kind of on the fence with this balance sheet right now between green and yellow, is I want to look at their debt to equity ratio. So their total equity was what? Let's see. Total equity was a little over $1.5 billion. And then their total liabilities will be, let's see, total liabilities, where is it? Let's see, right here. All right, 5. Wow. Okay, so they're like 5.1 divided by 1.5. Yeah, this debt to equity ratio is too high. Yes, I'm gonna give them a yellow. I don't like their debt load at all. In fact, I'm kind of really not happy about that. I don't like the shrinking equity, but the fact that they're buying back shares is a good sign that pushes them to the yellow in my mind, okay? All right, let's go to their income statement. Total revenues first, and you can see that, the equity per share shrinking probably has something to do with the revenue shrinking, and I'm guessing that we're going to be not making as much money. So, I mean, look, the revenue was growing, and now it's kind of taking a step back. So let's see. Let's look at pre-tax income. That's growing, so that's kind of a good thing, right? If your revenue's going down, but your pre-tax income's going up, it means your costs are really going down. So let me see if I look at their margin. I bet you their operating margin's higher. So let's see, this is their operating margin. Yeah, close to above 60%. That's pretty good. All right, let's go back to pre-tax income. All right, so I'm gonna give this one, I'll give it a yellow just because you had this down year where you lost a bunch of money. Your revenue is actually not consistently growing. It's starting to shrink, but they're not getting a red, obviously, because look at this. Their income's growing, and their revenue's still higher than it was 5 years ago. Okay, so what do I want to do for general rule of thumb valuation? Let's see. I'm going to say, let's say they're going to settle in around here, 2.4. Yeah, about 2.4 or $240 million a quarter. So $240 million a quarter times 4. 960 times 10, and then I'm going to ratio that to the market cap. So that's the ratio, 600. All right, awesome. So I think they should be worth $729 a share. Remember, these are very, very back of the hand, quick, high level screening processes. This is not a detailed valuation, but still, I think it's a really good starting spot. And this is a great one to have green, right? So buying back shares, growing income, revenue growing compared to 5 years ago, but kind of flat recently or shrinking recently. I think this is pretty solid. It might be worth a deeper dive. All right, let's go to ELY. That's Callaway. Man, I just realized how long I took on that first one. I'm sorry about that. I'm gonna go faster on this one. Okay, so equity, big spike up for equity. I'm guessing that was that acquisition. Maybe I don't know. They did something. Let's see. Usually it's a good thing if you make an acquisition and your total equity goes up. It means you were able to. I don't know, you would think it's hard to just grow your net worth by buying stuff, right? Because usually you have to go into some amount of debt to do that. And so it's a wash, Like if you buy a house or something and you put 20% down, then your net worth doesn't really grow, right? Because your 20% equity stays, your house is worth whatever you bought it for, and then your liabilities is whatever you borrowed. So really you don't increase your net worth by like buying things with debt, but somehow that's strange. I mean, that's good, right? It's just interesting. Let's see this again. Total equity, yeah. I mean, went up a lot. That's crazy. All right, anyway, let's see. How is it compared to their market cap? Yeah, now it's it's right at their market cap almost. 3.7, and they have a market cap at 3.7. So, really neat. PB close to 1. Let's see their tangible book, because maybe they just had a bunch of goodwill. Tangible book value. Oh, yep. Man, whenever things are too good to be true, they usually are, right? So their tangible book value is only $200 million versus a total equity of, what was it? It was $3.7 billion. Holy crap. That's horrible. I mean, it's not terrible. It's just not real assets, right? I'm sure they have a lot of goodwill. Let's see. Their total non-current assets. Let's look at goodwill and other intangible assets. Yeah. So they just booked a ton of goodwill as an asset. They booked, what is this, $3 billion as goodwill. That's strange. That's really strange. I don't know what to think about that. It's kind of got me confused. I'm putting a, I mean, it's growing, but I really don't like goodwill like that high. But you know what? Well, one more thing. This will decide red or yellow. I'm going to look at inventory and see if their inventory is increasing. Let's see. Is it raw materials or finished goods? Finished goods going up. Okay, I'm gonna give them a red. Whatever. All right, income statement. All right, this is good. Total revenue is growing. One thing though is that it's growing, but they bought a lot of equity, so I would hope that it'd be growing. If it wasn't growing, it'd be bad, right? And look, recently it's not growing as much; it's actually shrinking. So that's a little bit concerning, right? If you buy something, you want to be able to make more money, right? Because you want to keep your return on equity about the same. So let's see, what's their operating margin? Now that's really strange. Operating margin's just like all over the place and sometimes negative. So their gross profit is positive. Then their operating expenses are high. So let's see what some of these operating expenses are. Is it research and development? No, this is 20 million compared to a gross profit of like 500 million. So it's not R&D. Is it depreciation? Okay, no. Let's see what else. Is it SG&A? Yeah. Wow. So they're spending that much on sales, general, and administration? That's weird. I'm giving that a red too. All right, and now let's look at their pre-tax income. What? I mean, I knew this was coming, but yeah, it's just not great. This one's kind of confusing. I don't know what's going on here. Oh, this is their earnings per share. Look at this. So their earnings per share are just all over the place. Let's see. Let's say that they're going to average, 0.25 cents a quarter. So 0.25 times 4 is 1. Wow, I can't believe I just did that on the calculator. Well, okay, 1, and then like a PE of, let's say, 10, maybe 12. I'll give them 12. So 1 times 12 is 12. I don't need the calculator for that. So I'm going to put 12. So I got red across the board for this one. Kind of surprising at first glance. I remember thinking this one looked really undervalued to me, so I'm a little confused about that. So next up is VF Corp. So first off, we have total equity. Now, I did better this video because if you look in the top right next to the VFC ticker, I have an asterisk, and what that's there for is to remind me that they pay a big dividend. I think it's like a 4% yield right now. So I'm not going to be as harsh judging total equity, right? Because total equity of a company is their assets minus their liabilities. So it's really a good judge if you're judging somebody that doesn't pay a dividend, that's keeping all the money in the company to continue to grow, that sort of thing. Companies that are paying a dividend, they're sending money out of the company, so it's not going to help their equity, but it's going into your pocket. So it's a plus, but you're not going to really get the full picture by just looking at equity of a company, okay? So that's not I'm not going to be too harsh about this. Now, that being said, I would rather see it, at least flat versus decreasing. So but I'm not going to be as harsh on them. What was VFC? Oh, they were the clothing company. Okay, so I definitely want to look at inventory for them. Inventory's going down. That's good. Let's see. Is it finished goods going down? Raw materials? Let's see. Going way down. That's interesting. So one thing about raw materials going down like that is that, and this could just be accounting, this could be how they're factoring it in, right? How they count their inventory. But in general, raw materials going down means that the company's preparing to not have to meet as much demand, so they're not carrying as much inventory. So that's a little bit concerning, but I'd want to know more about what exactly they call raw materials before I really get aggravated about that. Okay, so let's see what else. I'll get a debt to equity ratio. So let's see their total. Oh, this is total non-current liabilities. Let's look at their total liabilities. And that is $10 billion. Wow. And then their total equity is 3.8. So 10 divided by 3.8 is 2.6. Yeah, I'm not a big fan of this. I'm giving them red. They got, in my opinion, a lot of debt. Their equity's not growing that much, and the inventory going down is a little bit concerning, but like I said, it's just a quick screening. All right, let's go to the income statement. All right, revenue, and this is very cyclical, and I guess that's what happens if you're a clothing company, right? Apparel, you're seasonal, especially if you're a winter apparel company, right? Like North Face. I mean, who's going to buy a North Face jacket in the summer, right? Yeah, and then they got hit hard by COVID here. You can see, I bet you that's going to be huge losses on their income statement, on their pre-tax income. Yeah, wow. Now look at this though. They're recovering pretty good. I mean, they're above their highest quarter ever, but still, see this? This is just very, very flat. If you gave me, to me, there's thousands of companies out there. I'd much rather own a company whose income's going up than a company whose income's doing like that. And there are plenty of companies that I think their income's going up. That being said, though, it's about what you think the income's going to do 5 years from now, right? Because this really doesn't matter in the grand scheme of things. Past performance doesn't really affect the valuation, right? Because the true value of a company is the net present value of all of its future cash flow, right? So past results don't really do much except help you predict future results. Well, in this case, I mean, it's pretty consistent and it's pretty unimpressive. So I'm not too thrilled. Let's see. I'm not going to give them a red because they're not losing money consistently. Let's just look at their, I don't need to look at anything else. I'll give them a yellow. And then I need a value. Let's see, what value do I want to use? Let's just boom right here. $400 million pre-tax per quarter. So 400 million is 0.4 billion times 4. That's $1.6 billion a year I'm expecting in pre-tax income. Then since this company's not growing at all, I'm going to multiply by 8 just because that growth is pretty terrible. And then ratio that to the share price. So, all right, $33 a share. Yep. Don't like this one either. All right, let's go to PayPal. PayPal's one that a lot of people have been watching for a long time because, like I said, it crashed, I don't know, like 70, 80% recently in the last year. I think one thing that's been affecting them is that they have a lot of increased competition, right? For a while, they were the only game in town as far as like online payments, right? And now you got all kinds of other ones, Square, Zelle, Venmo, you name it. All right, so let's see. That's their equity going down recently, but it had been going up. Let's just see what their PB is. Yeah, they're selling for like more than almost 5 times their book value. And let's see, what's their tangible book value? Now, I'm judging them by this right now in the balance sheet, but y'all know for like software companies, I'm not that big of a critic of a balance sheet, because it's all about making money whenever you're a software company. You don't have that many assets. You're not going to like go under usually. Let's just make sure they don't have a lot of debt. Let's see. Their equity was, what did we say? It was $20 billion. Their debt was, total debt, total liabilities. Yes, man, why do they have so many liabilities? Okay, I don't know. I'm giving that a red. Sorry, I'm in a harsh mood today, I guess. I don't know. Let's go to income statement. Revenue's growing, but, first quarter lower than the other ones. I mean, I'm sure that spooks some people. That might be why stock's been dropping a bunch. Probably not. Something like this is not going to make the stock tumble like it has, right? Let's see. What else could it be? Let's look at pre-tax income. Now, that'll do it. To have 3 consecutive down quarters, yeah, it's oof. You're making $600 million a quarter right now. Oh man, you're gonna be like way overvalued. Holy cow! I mean, look, the income statement's yellow. It's growing. It's not losing money. And like I said, it's growing, but the value, I can already see it's gonna be extremely overvalued. So let's say like even best case scenario, they're making. And remember, this is my opinion of what best case scenario is. So like, let's see. They make $1.2 billion a quarter. So even if they make $1.2 billion a quarter, I still think the stock is way overvalued. I don't know. Yeah, something's off here. Like I said, I'm being tough today. I don't know why. Okay, let's go to SFM. All right, so let's hope this company's not as expensive as the store, right? That sells organic groceries. Some of those things, man, kill your wallet. All right, so let's see. That's good for the shareholder though, right? Okay, so let's see. Equity's going up. I wonder what happened here. This would have been not a good time to be an owner right here, to just have the equity going down like that. Let me look at it on a per share basis. So your tangible book so this is your tangible book value, all right, and then let me look at tangible book value per share. Good growth recently. Let's see, are they buying back shares? Yeah, they are buying back shares a little bit. That's good. Let's see, inventory about steady. Okay. Yeah, I'll give them a yellow. There's nothing bad here, but also nothing like outstanding either. All right, let's go to the income statement. Total revenue growing, but starting to go sideways a little bit. Let's see, what's their operating margin? 3 to 5%. That's not a good margin. I guess it's the grocery store margin. I think that's how grocery stores are. They don't make big margins on their products. Still, though, I thought a company like this, the big organic food companies would have big margins because like I said, the stores are super expensive. All right, let's go to pre-tax income. Yeah, it's not really. Nothing impressive here either. I'm going to give this one a yellow on the pattern, and then let's get kind of a value. Let's just say 60 million a quarter. So 60 million a quarter times 4 is 240 million a year. Multiply by 10, and then ratio that to the share price. This one's going to be yellow across the board, it's looking like. Yeah. So not great, not terrible. I'm not going to be looking into that one any further either. All right, let's do the last one, Scott's Miracle-Gro. All right, finally we get an equity growing that's not shrinking recently. Now, Look at this though, $1 billion is their equity right now versus a market cap of $6 billion. Like I've said before though, you read old investment books, like even like as early, not as early as like recent as like Peter Lynch books, and I got one right here, I think, yeah, on my desk. That's where the quote up top, I read that in Beating the Street. It's a great Peter Lynch book. But even he talks about buying companies that, you know, are at low price to book multiples. Ben Graham talks about buying companies for less than working capital. It's just, it's crazy to me. Scott's Miracle-Gro. Okay, let's see. Let's look at their inventory. Now, this one is a cyclical business, right? Because people's lawns don't grow in the winter. At least mine doesn't, right? So, now let's see. Wow, that's weird. Inventory is rising recently. Let's see. Is it raw materials? Okay, I'm just missing a data point there. So that's not, I wouldn't panic about that. That's just, I'm missing that data point. It's the raw materials that's going up because finished goods is actually, I'm missing a data point there too. All right, anyway, I'm not going to count that. Let's see. Let's just look at their debt load. So total liabilities, about $5 billion of total liabilities, and then their total equity, let's see, 1. Man, so they're leveraged. They have a debt to equity of like 5 divided by 5. Well, I just did 5 divided by 1 on the calculator too. All right, this one's red too. I'm sorry, but you know, you can't be that leveraged. I don't like that, being 5 to 1 leveraged. Okay. So let's see. Let's go to revenue. Goal. Talk about cyclical, huh? Look at this. Now, it is growing a little bit recently, but man, strange. Okay, let's look at their operating margin. Let's see what kind of margins they're getting. Yeah, I don't like cyclical companies. It's just so tough to value them. Let's see what else. Let's just look at their income. Weird. So let's see. Let me just split the difference and say, on average, $200 million a quarter. So $200 million a quarter is $800 million for the year, times 10, 8, divided by 5.8 times 105, 144. All right, so this one, I would say the first and the last one would be the only two that I'd really even be super interested in looking into any further. And I don't know about Scott's either, just because, like I said, I don't like being that leveraged. I don't like seeing somebody who's got a price to book of 5 and a debt to equity ratio of 5. And like I said, this was a very back of the hand calculation for the estimated value. It could be lower than that. So anyway, don't be discouraged if bad talked one of your companies. Like I said, this was very high level. This is just kind of like my thought process as I go over stuff. This is my first impressions. It could be better if you know the company and you know what the future holds, right? Because all I'm doing is using past results to kind of do a future prediction. I'm not doing any forward-looking analysis, right? So anyway, that's all I got. If you enjoyed the video, like and subscribe. I got more videos on the channel that are more centered around individual companies and deep dives, including some that I really like. So hope you enjoy. Check it out. I'll see you next time.